Today, we're focusing on a growing category, active ETFs. I'm Ted Malcolm, Head of UK ETF Distribution at JP Morgan. Let's start with the basic distinction between passive versus active ETFs. A passive ETF is designed to track a specific index. That could be something broad like the FTSE 100 index, or more niche like an emerging market index. The fund manager does not try to beat that market. They simply aim to replicate the index performance as closely as possible. It's rules-based and low maintenance. An active ETF, by contrast, is run by a fund manager who makes decisions about which assets to buy or sell. Their goal is to outperform a benchmark, not just match it. That might mean underweighting certain sectors, avoiding poorly performing companies, or rotating the portfolio in response to macroeconomic changes. Now, you might also see the acronym REI. In this context, it stands for Research Enhanced Index, a strategy that blends traditional index investing with elements of active research and stock selection. Rather than simply tracking an index mechanically, REI ETFs aim to slightly improve returns or manage risks more effectively through selective adjustments based on fundamental insights. So what's the appeal of active ETFs? They offer professional decision-making. Your portfolio adjusts dynamically to new information. They provide flexibility in turbulent markets. An active manager can take advantage of price dislocations or avoid sectors they see as high risk. They're listed like any other ETF, meaning they're tradable throughout the day and generally more transparent than other investment vehicles. But there are trade-offs. Active ETFs often have higher costs than passive trackers due to the management and research involved. There's no guarantee they'll outperform their benchmark. Some do, some don't. Additionally, active ETFs may require more due diligence by investors. Let's take a practical example. Suppose a passive ETF tracks a broad equity index. It will include everything, strong and weak performers alike. An active or research-enhanced ETF might exclude companies with weaker fundamentals or overweight those with strong momentum or improving outlooks. That can help manage risk or boost returns if those choices prove correct. JP Morgan Asset Management, for instance, manages over 120 active ETFs globally. While we won't cover specific funds today, these typically involve sector specialists, macroeconomic forecasters, and valuation analysts working together to decide what goes into the portfolio and when. Ultimately, whether an active ETF is right for you depends on your goals and risk tolerance. They can sit alongside passive ETFs in a well-diversified portfolio. Some investors are willing to take more risk and use them to seek outperformance in sectors they believe are mispriced or inefficient, such as small caps, emerging markets, or thematic areas like clean energy. So to sum up, passive ETFs aim to mirror a market. Active ETFs aim to beat it. Each has a role to play depending on what you want from your investments. Understanding the difference is a key step in becoming a more confident and informed investor.